Hello, good afternoon. Welcome to our webinar today. Thank you for taking the time to participate. We are very happy today because we are going to have all our UCITS portfolio managers covering macro views and say what they think about the risky asset class going to Q4 for 2021. So we believe it's going to be very interesting, also considering what happens in these last couple of days. At the end of it, we will have a little bit of Q&A, say round table, just to cover the main questions that investors are having these days. Of course, anytime, please just use the chat, so we will be happy to answer also to other questions that we didn't think to cover. I'm gonna move to the first portfolio manager, so to Filippo. Welcome, Filippo. Just for the benefit of the ones that doesn't know him, Filippo is our portfolio manager for HI Credit Fund. This is a long-short opportunistic credit fund with a strong macro overlay. He has track record starting at the end of 2012, so many years, and analyzing at 5% net return for clients. So we believe this strategy is very interesting, and in particular in this new scenario, in this new macro environment. Filippo, I leave it to you to comment on the market and on the credit market in particular.
Fantastic. Thank you, Laura, and thanks everybody for being here and taking the time to listen to our view. The situation in the markets now is clearly quite challenging. Obviously, I mean, we are effectively at the end of 10 very, very strong years of financial performance, even with the small interval of the COVID last year, which was probably to be measuring weeks rather than months in terms of weakness in the markets. And obviously, a lot of that has been driven by quantitative easing. We are truly convinced that one of the reasons why the valuations are where they are has got nothing to do with, you know, something special in this part of the human development, but more like with the quantitative easing that we're seeing. And so obviously that's very, very important. On top of that, obviously we are exiting a global pandemic. There is quite a lot of inflationary pressure. So from that point of view, we look at long-only strategy, which have been the absolute winners on pretty much any asset class, including commodity with the last couple of years' performance. Long-only strategy have been the absolute winners for the last 10 years. Probably the best thing to do after the financial crisis was just to be long and effectively stay long and invest continuously without any or very little, you know, reshuffling of the portfolios. Whether you did crypto or you did BTP or equity, it would have worked fantastically. The reality is of now, we think, you know, a long-only strategy, a long-only approach actually, which is quite bigger than long-only strategies, is quite dangerous. You know, we think there's a lot of like risks in front of us, and that's why, you know, we are very cautious, very alert on the macro side, and like we've shown last year, we are prepared to go aggressively short if the market requires that to protect the portfolio and actually to benefit from bearish move in the markets. But at the same time, we're very respectful of the activity of central banks and governments alike at the moment, which are very interventionist, very active on the economic scene. The real question for us is that, you know, we want to be very opportunistic, but when is there true dip? Was last night a proper dip? It was just a temporary one to be bought once again. And with that, obviously, we are spending money. We're putting the money where our mouth is. And just this year to date, we probably invested almost 5% on, you know, out of the money shorts, put option, different hedging strategy, and different, you know, outright short strategy, which obviously reduce the performance, but our performance is still, you know, double digits. The reason why we're keeping it is because we think increasingly we're very much like the picture we put on the slide. You know, there's a very tight, very fine line to cross now to maintain, the current valuation, and not to mention actually to grow at similar levels what we've seen before. So obviously we like being short, we like having the shorts as an opportunity, but at the same time we're very agnostic. We're going to be very much trying to make money, however we can. And the main driver for our performance is going to be credit and equity selection. We're going to be very focused on picking up what we think are the winners on the long and what we think are the losers on the short side. Obviously, on the loser side, shorting specific names has been quite painful, maybe excruciatingly so for the last few years. But as we've seen with Wirecard, we've seen with Chinese credit, sometimes it's just a matter of having the right patient and the right time frame. But eventually, a lot of the imbalances that we see will come to fruition from the short side. On the long side, obviously, we are super focused on the fundamental and the catalyst. We always like to have a combination of both, like strong fundamentals to be long, but at the same time, some catalyst to make things happen. And that's where we really, really focus. So overall, in summary, our approach is to be very focused on selection for our long-short portfolio, and not be afraid to have short position, especially in credit where the downside upside is very much skewed in favor of having shorts. And to build a portfolio that actually can produce capital gains on both the long and the short, like we've seen for the last couple of years. On the macro side, again, we try to be very alert, very disciplined, very respectful of the powers of central banks, but at the same time, very opportunistic if the situation forces to operate and to be more aggressive on the market side. Maybe Laura, if you can move to the next slide, just to obviously on the macro side, we all know there is plenty of issues. I guess for us, the most concerning is that we have a bit of a slowdown in growth, but we have enough inflation, whether it's temporary or structural, it's very difficult to know. Nobody's really have a crystal ball. I think ESG and energy transition are very structural. So I think a lot of the inflation that we think or deem temporary now is probably going to be a lot more structural than what we think, just simply because the capex and the investments on traditional energy has been very, very modest for the last 5-10 years. And I think that will probably be even worse. But obviously there are technological advancements that will make energy production cheaper and cheaper. So that is a big thing for us, but I think a big thing for macro as well. On the other side, the other big driver that we see short term is COVID. We've seen plenty of new medical protocols, vaccines, and everything else. And again, showing that humanity has an incredible ability to innovate and overcome any challenge compared to the expectation. The reality is that for the financial markets, not having any COVID issues probably be a big problem because then would accelerate, especially with some sort of resurgent inflation, will probably accelerate some normalization in monetary policy. And I think that is probably the worst case scenario for the markets right now, is that we have this sort of lingering growth, but inflation that doesn't really want to disappear that quickly. And at the same time, COVID not being an emergency, then I think, that will trigger some attempt to normalization, whether it's the Fed, Bank of England, ECB or China, we'll find out. But I think that is probably our base case scenario, that I think we will see COVID being, pretty much under control, growth being okay, but not as exciting as after the reopening. And that obviously we will see a lot more reduction on the QE stimulus in terms of speed, intensity, aggressiveness. If we could move to the next slide, that is just an example of what we are trying to do at Newman. The vast majority of the book, the structural part of the book is long and short across the capital structure for different issuers, predominantly in credit, obviously. Where we do a lot of fundamental analysis on the fundamental driver, the cash flow driver of the company. But at the same time, we're very attentive to what will be the catalyst and the calendar of events ahead that could actually make our investment thesis perform. Ferroglobe is a perfect case of a good, credit selection. It was all across the capital structure. It's a name that we've been following for a long time. Everything was aligned, as in they were in a very good, industrial/commodity sector, which is silicon metal. They were very leveraged, so they needed like a proper restructuring after the COVID disaster. And then at the same time, they were like in a sweet spot for trade wars between, US, Europe, and China. We very active during the restructuring. We had the opportunity to be exposed to both new security on the bond side and the equity side. And the equity almost tripled, and the credit actually as well almost tripled as well since the very low points, which is where we see the big opportunity going forward, is really like selecting the right credit, the real winners, spotting names that are under stress, duress, difficulty, either because of trade war or because of COVID or because, excessive leverage. But that's where we see a lot of opportunity. Ferroglobe was a big name in US in terms of the decent market cap of between debt and equity, but it was still an opportunity where we could get in at triple-digit return cash on cash over the last 12 months. And so that obviously is a case of a successful credit selection. The interesting thing, obviously, in a very algo-dominated world, credit is still very much immune to that. It still does pay to do quite a lot of like credit research, especially when it comes down to the non-investment grade area, which is where the real opportunities are, but also both in terms of long and short. And if we can move to the next one, which is, a case of, if you want, a selection that ended up badly, not for us, but I think for the market, obviously it's Evergrande. Everybody talks about it. So, it seems the coupons are not going to be paid. I think we've seen some rumors, but some speculation in the market, and that seems to be the consensus. I think for us, China has always been something we've been very negative, very bearish. I think, the last few months actually, prove our concern, especially on the credit side. There is no predictability of the political picture there. Whether it's regulation of video game consumption or tutoring agencies, or whether they're going to bail out or bail in Evergrande. The reality, a lot of people really like China. We think China for us is uninvestable from a long point of view most of the time, just because it's a massive black box. We have, if everyone trying to spend some time on Evergrande, the reality is you can't really find the data. And nobody really knows how big is a shadow banking, especially through the trust wealth management kind of products, which is a massive, shadow banking in China. So our view is that China will offer a lot of shorts going forward, definitely in credit. Equity, obviously, we've seen a big correction. I think kind of probably a little bit done now on that side. But I think on the credit, we see, given where rates are globally, the valuation and, the massive market consensus on long yield, we see a lot of like potential disasters coming from China going forward. I think Evergrande will be a big test. There are two big things about China for us, that there is not just a credit bubble, it's a political bubble. There is almost unrelenting faith from any market participant that the Chinese authority will know exactly how to manage the economy to the last decimal point in terms of growth. We don't believe that. History has shown many times that nobody can really do that. And I think there will be macro policy mistakes, number one. The second issue that we see related to China, obviously, is ESG. We are true believers that ESG will be probably the biggest driver of investment portfolio construction over the next 5 years. There will be, good and bad, impacts from there. E is definitely at the top of it, but let's not forget S and G. If that kind of train start really going the way we think, ESG will put a lot of pressure on emerging markets, and China is one big question mark. Is China investable from an S and G point of view for a lot of investors going forward? We don't know. So we see again, in terms of credit selection, with China as one great place to look for, potential shorts, especially on the offshore market. And I think is one of the places where we can actually get good funding for our core long position, which we believe. But again, we're totally agnostic. I think from a thematic point of view, the biggest driver for us in terms of investments will be ESG, effectively, mandated, kind of investment and portfolio reconstruction that we expect happening. The impact of ESG on behavior of companies, and refinancing, and that, specifically within that, obviously the energy transition is going to be a massive driver. I think we experimenting now, gas supply being very low in Europe, the exposure to Russia, obviously trying to transition to, a new green economic model, the election in Germany. So there's going to be plenty of that. We played really actively on that, especially on the hydrogen space, electric vehicle. It's something we're still very exposed, and we think there'll be plenty of opportunity there, both long and short. In terms of the other thing that we see obviously is technology and the way it's impacting the credit market. I think, whether it's, especially within 5G, telco is a place where we really think that is becoming more and more like a strategic infrastructure. There's going to be plenty of, M&A transactions, there's going to be plenty of reconstruction of balance sheet there. And that's something else that we're very focused. Laura, I think, pushed me into the last slide, obviously, because I think we are a little bit under time pressure. Sorry for being a bit slow, but on that, obviously, this is our performance. We're around 9.99 for the year to date, 2021. That's after we pretty much invested 5% on the short. I mean, and by shorts, I mean macro shorts, away from, single name shorts or, hedges. So we do spend money for our macro approach, and it worked very well last year. We do expect it to work very well in the next couple of years, but the structure of the book the core is long short fundamentally driven. And, we really like the investments landscape right now. I think there's plenty of opportunity going forward, especially for our, ability to be truly long and short. And then obviously our ability to be very deep in terms of fundamental analysis. Thank you.
Thank you, Filippo. We'll come back to you at the end with some questions, and we're going to move to the equity space, and in particular with Paul Manager. Paul is managing for us HI European Market Neutral Fund since the beginning of 2020. The strategy is a real market neutral, so with net exposure below 10% either sides, and with a focus both on European companies and on the UK space, which is also a huge expertise for Paul and his team. So, Paul, I leave it to you to comment on the portfolio and on the equity market space.
Okay, thanks very much, Laura, and good afternoon, everyone. We had a few technical difficulties at the end, so at least I wasn't on first. So yeah, it's been a really interesting year for running any long short money. We run UK and pan-European long short money. And we've had that transition in the market, I think, this year we came out of 2020 in a very much, value domestic growth is good pretty much wherever you were in the world. And all the things that had done well for you in the previous kind of decade were suddenly no longer in favor. So a sort of portfolio that was kind of short global growth and long domestic and recovery and reopening was pretty good for you for the first half of this year. We were probably a bit behind that curve in this fund and probably were a little bit too defensive really for that market. So we made a fundamental change in the middle of the year and brought a much more balanced approach with a lot more of a UK focus into the strategy. And I think that's proved to be really good. In fact, you can see that in the way the performance has recovered very strongly since we made that change. And a lot of credit goes to Seb Jory and Fred Batois, who do most of the day-to-day running on the strategy, who've made that transition really well. So what have we actually done in that transition? Well, what we've done is we've introduced a much broader range of stocks, and we've significantly increased the UK exposure of the strategy. So we've gone to a strategy that is kind of 60%, 65% UK, 35% pan-Euro. And it was probably 25 before. So really, really upped it. But partly because, we back our own here at Tellworth. We think Tellworth's pretty good at UK. But also, we just think the UK has a much broader opportunity right now. It's a market that's been unloved for such a long time, particularly post the Brexit referendum and through all the many issues the UK's had. We love an issue in the UK, and we like kind of seeing the opportunities that creates, be it the fact that we want to go off on our own in the post-Brexit environment. And that actually has created some fantastic opportunities, long and short. So the switch to more UK has really, really helped us, reopened up the wider opportunity, probably gone a little bit down the cap scale, although not really into small caps, but a little bit more there. And you can see that on our long book, more longs, particularly at the bottom end of the cap. That's really working. We like the idea of getting emerging companies, through perhaps the most dangerous stage of being a small cap, but as they come into mid caps, that's been good. And in our short book, generally a bit bigger cap and also some indices there. But interestingly, we've introduced more single name shorts, and generally that's worked pretty well for us. We're quite sector agnostic. I think one of the big themes of this fund is to try and move away from too much factor-driven investment, too much kind of, are we in growth, are we in value, are we long growth, are we short value, or are we the other way around? Because fundamentally that's a tail chasing or what we sometimes call ambulance chasing strategy. And the market's a washing machine, and you're very rarely ahead of the rinse cycle. So what you need to be thinking about there is kind of stepping away from that a little bit and saying, right, let's be bottom up, let's meet management teams, and let's pick stocks on the back of that. And that's very much our heritage. And we've brought that much more forcefully into this strategy this year. And thankfully, it's working well for us. So we don't get too worried about the sector positioning, but you can see generally that we've got quite a balanced portfolio. In fact, most of our sectors, we've got reasonable long short balance, with a few that stand out. But we don't really look at sectors per se. We're looking at the whole strategy and, looking at the fact that, we've got 70 odd longs, 65, 70 shorts. It's a pretty balanced portfolio, a few more index shorts, as I mentioned. So maybe it's a good idea to talk about the kind of thing that's working for us on both sides of the book. So the UK has been an interesting one for us this year because it's actually not been UK domestic winner stories. They were great last year, but they've not been so good this year, but that's kind of played out. And I think if I'm being honest, as a sort of UK manager, that's been a bit disappointing that the steam has gone out of the UK domestic trade a bit earlier than we might have hoped for. So actually the best place to make money in the UK has been more like longer term recovery stories that have got a bit of self-help. They're companies which perhaps were once great and big and popular, but are now coming back. Sage is a great example. It's a world leader in small business accountancy. Everyone gets very excited about things like Xero, which is a New Zealand business, become a global leader in small business accountancy. Sage has actually got a really strong customer base. That's been a great investment for us this year, picking up a really unloved stock with improving earnings momentum. We've had a very similar thing in Marks and Spencer, the UK retailer. Marks and Spencer hasn't had a profit upgrade for a decade until last month. This is a business which has worked out what it's good at. It's good at selling food. It's got a good JV with Ocado. People no longer want to buy suits. People may want to buy pants and underwear from them. That's fine, but they don't need 400 shops in the UK. So they really thought about what they're good at and seem to be making that change. And the stock market's been very slow to decide that's a good story. And we've really caught the cusp nicely. So UK recovery is a really good place for us to be in terms of both UK economic recovery, and I'll come on to some of the challenges we might face there, but also companies are in that self-improvement phase. We like self-improvement. That's a good thing to find. In Europe, we've been a bit more successful, probably in a balance there. Stellantis has been great for us, which is the Fiat Renault combo. Fantastic recovery story for us. Saw it much earlier than the market. So really like that. Still a big position. Still think it's got a long way to go. Bike24. We've worked out in online retail across all the different IPOs we've looked at that if you're going to go for an IPO, it's got to definitely be the number one e-commerce player in that sector. And if you can dominate that sector, you can be a really, really good story. But you don't want to be number 2 or 3 or 4. And you really do need to be number 1. You need to be the market leader of the niche and have the ability to grow the margin in that niche. And Bike24's there, came out of Germany, everything to do with the bike, pedal bike, little chain logo is a bit of a giveaway there. And that's been a great IPO for us. Wasn't super popular at IPO, but as it's delivered good numbers, it's coming through. And they're often the best IPOs, not the ones that are super popular on day one, but come through later. ASML, really core, long-term. The global semiconductor shortage is only be solved by more semiconductor capex in the medium term. ASML make the kit that make the semis, really good long-term, and a great one to buy on the dips when people decided growth was out. ASML was the stock to buy, so that's done well. Left-hand side of that little group are our shorts. Admiral, UK car insurer, people are getting back in their cars, they're having crashes. So that means losses are going to go up. And that means that for that business, their earnings are probably going to go down. And it's still very, very highly rated. It's had a fantastic COVID because no one got in their cars, but no one's really realizing that it's going to normalize. Things are going to get tougher out there for car insurers. Domino's Pizza, okay, great pizza brand, but everyone goes to Just Eat and Delivery Hero and whatever you have in your home country. And that delivered takeaway, Domino's is one of many rather than the only one now. Deutsche Börse, bit of a financial reverse for us. We see that as a good general financial short with a little bit of overvalued quality in there. So quite a nice short play. So a few ideas, bottom up, balanced portfolio, looking for some good thematic recovery plays. A lot of work behind the scenes here, meeting management teams and modeling some of the opportunities. You can see there that balanced portfolio of longs and shorts, pretty limited net. We upped the gross. I think we felt the strategy was working nicely, and we upped the gross when we increased UK, and that's been absolutely right. So it's been a tale of two halves a bit. We've almost inverted 2020. 2020, we did fantastically when markets were awful, gave it back a bit in November when we had the change and then recovered. This year, struggled to get momentum really until we slightly changed the view. We want to get out of that washing machine before the tumble dryer and got into what we would describe as a much more fundamental stock picking phase, which has worked really, really well for us. And I think the momentum we've got at the moment is quite sustainable. So what are the challenges we face going into Q4? Now, we've all talked to, and I think Philippa and no doubt Sanjeev are so much better on all this kind of macro stuff, because it's definitely not my forte. But what I do a lot of is meeting companies, and what are companies worried about? Companies are really worried about raw material price inflation, and they're really worried about labour shortages in the UK particularly, but we see that across Europe. So we see labour shortages as a pan-European issue as well. So we're in a bit of a hiatus. I think the gas price spike is just the sort of thing that makes companies look hard. And what we're seeing is that companies who perhaps were sitting on a big earnings upgrade just aren't putting that through. That's a bit of a headwind, I think, as we go into the fall. Is how are some of these kind of things going to settle? We know some things are transitory, but everyone's now deciding that the CO2 shortage and the gas price spike is with us for a few months. So I think that might take away some of the inherent momentum in our long book and in long books in the UK generally. So what we've been doing is actually trying to find more UK shorts in particular. We don't think the market's got kind of worried about this enough yet. So we think there's some great shorting opportunities off the back of this little height. I don't see it as a really long-term issue. We speak to a range of businesses and things like distribution are pretty confident that we get through the worst January, February. In the UK, people get very excited about these sort of Christmases, council stories, a lot of noise, not really backed up by much reality. But the things we're looking at particularly are CO2 shortage, which we think has got reasonably wide implications, and it's quite a difficult one to solve. The irony, really, thinking about ESG, and what the longer term implications of the gas price issue is, probably a shorter term issue. But so there are two things we're looking at in our portfolio. Lots of opportunities on both sides of the book. And I think the transition this year into a slightly more focused, smaller European book and a broader UK book, where fundamentally I think we have quite a good edge and a great record, is paying off for us as we come up to 2 years running this strategy with Hedge Invest. So hopefully that's given you a bit of a feel. Please do ask questions. I'll do my very best to answer them later. But I'll pass back to you now, Laura. Thank you.
Thank you, Paul. And I'll come back to you later. So last but not least, Sanjeev, we started to work together back in August. So in the summer, we launched the initial share class for this long-short equity emerging market fund. Sanjeev and his team have a very, really long track record. Sanjeev track record goes back to 2005 with really great numbers. Also the hedge fund the team is managing since 2018 has great numbers, so we are super excited. Of course, this timing is quite interesting for emerging markets. And so Sanjeev, I leave it to you just to give a little bit of a picture on China and the emerging market investable space in general. Thank you.
Thanks. So we just started with this UCITS fund in August, and had a pretty nice start with a few of the ideas coming through. But let me just start with what are we trying to achieve. So we are a bottom-up focused long-short equity strategy. We run a plus minus 30% net exposure. So we're trying to be market neutral, but we are quite factor agnostic and quite sector and country agnostic. It's really about the bottom-up fundamental ideas. We're trying to find alpha longs and alpha shorts. So this isn't a strategy which is a relative value or a pairs trading strategy. It's very much trying to find great companies to go long and great company and really bad companies to go short, and then trying to make money out of that and manage risk around that. What we're trying to do is achieve double-digit returns. We're trying to keep volatility at 7 to 8%, and we're trying to control drawdowns to 7%. So our goal is to give a high quality alpha return with very little market exposure. And to do that, we take a 4-step approach, which we've got on the slide there. The first step, which is the bottom, which is the starting point of the process, and we build up from there, is stock selection. So we've talked about a little bit about finding alpha longs and alpha shorts. So this is about identifying great businesses to go long and identifying structurally challenged businesses to go short. I'll just echo Paul a little bit in that, one of our core holdings as well is also ASML, and probably for very similar reasons. But it's a phenomenal alpha long, which is pinned to being a core supplier to the semiconductor industry. And it's a core long that we've had in our portfolio for the last 3 years. So it's really about finding those businesses that we think can make excess return on capital over time in a sustainable way, and hence exploiting those opportunities. So step one, alpha longs, alpha shorts, find the great stock ideas. Step two for us is to look at the country analysis, and from that, determine the position sizing. So this is where the little bit more of a macro flavor comes in. It's step two. So we look at how the country environment affects the business's ability to make return, and whether that's a corrupt government, whether that is a country that runs twin deficits, whether that is a company that's dependent on oil imports. It's really trying to understand what the country dynamic is, and is that a good, or is that a headwind or a tailwind for the business that we found? A lot of other people will do it the other way around. They'll look at the country first and then try and pick stocks. Our goal is to find great businesses, because great businesses tend to stay great businesses as long as the management perform well. Countries tend to change a lot between being good and bad. For example, Brazil in the last 3 years has gone from being a good place to invest to a bad place to invest to a good place to a bad, and now is becoming potentially a good place again. The fundamentals of the companies there and the quality of the businesses hasn't significantly changed, but the operating environment swings a lot. So our starting point is to find those businesses, and then when we see those changes in the country, we can take the sizing up and down. The third part of our process is implementation and building convexity. Here we are trying to implement in a way that is convex, so that when we're right, we make bigger returns, and when we're wrong, we don't lose as much money. Now, there's a lot of different ways of doing this. And we do 3 different things to build convexity in the portfolio. Firstly, we look at valuation, price targets, and we try and implement ideas where we've got much bigger upsides than we have downsides. Second thing that we do is active risk management. That means something we call dynamic hedging. So we will, stop loss from losers. We will run winners effectively, and that also gives you convex implementation. The third thing that we do for building convexity, which is very different to a lot of other people, is that we use the whole cap structure and optionality to build convexity. So we look at the options market to see where we can get accretive optionality to build that convexity in the portfolio. So whether that's a warrant, a convertible bond, a listed option, etc., we're trying to change that risk reward outcome in our favor. And the final step of our process is the top-down risk assessment. So, we start bottom-up fundamental, and we finish at a top-down risk assessment, really to kind of mitigate risks of things that we're worried about. So whether that is a China hard landing, whether that is a China invading Taiwan, or some other risks, those types of risks, those big macro risks, or even, as Paul alluded to, the energy situation that we have right now globally. Those are the types of risks that we're thinking about at that top level, and then we're implementing tail hedges in the portfolio to protect the portfolio from those risks. So that's really how we think about investing. This year has been, the last 18 months have been quite interesting in terms of the way the world has changed, especially the way the world views China. So I'll come back briefly to Evergrande, where the situation there has been developing for the last 12 months or so, since the government changed their rules around property developer leverage. And Evergrande is the result of a company that ignored the Chinese government and ignored what the Chinese government want to happen. We've got a lot of those examples in China over the last 12 months. Ant with Alibaba. Ant was a systemic threat to the banking system in China by disintermediating the banks. And it paid the political consequence of being in a place that was against the wishes of the Chinese government. Tencent, which is another big internet player, which is more focused on gaming, again has fallen foul of the Chinese vision of a harmonious and well-being of society, and is now in the doghouse in terms of its place in that new social prosperity agenda that the Chinese government have. So there's been a general overall attack on anyone that is considered a sin stock. So whether you are a gaming stock in Macau, gambling, white spirits, all of these education, where you had education companies trying to promote outside of school tutoring for profit. The Chinese government has taken a very dim view on all of these business models, and has basically said, look, either you work for the social good, or we will implement policies that will impact your business. So whether China is investable or not is a big debate. There are things that we think fit the government's agenda, where companies are doing incredibly well, are cutting edge, whether that is 5G, artificial intelligence, smart cities, traffic control systems, all of these things that make people's lives better every day, electric vehicles, batteries, that sort of innovation. And we think there's opportunity to invest in those. We are avoiding anything that is a luxury or considered to be a vice of any form in terms of society's implementation of that. So where are we today in terms of what's going on? China is undergoing a growth slowdown right now. So part of the problems with the equity markets in China has been the government interventions, but part of also the problem is that China is undergoing a significant growth slowdown. The forecasts are 4.7% for fourth quarter GDP. And the thing that's driving that growth slowdown, if you look at the chart on the right-hand side of the page, is the white line there, which is the credit impulse data in China. So as you can see, that credit impulse has dropped off quite substantially since the beginning of the year. Credit is slowing dramatically, and that is impacting the Chinese economy. So, and part of the reason why that credit growth has been reined in quite dramatically is that producer prices were rising rapidly in China. And the one thing that China is ultimately very scared of, and the big weakness China has, is inflation. China, the last time when Tiananmen Square was happening and all of that stuff was driven by inflation. And we've had periodic inflation scares over the years, whether it's pig Ebola or other factors. And whenever you start getting inflation, the Chinese will clamp down on it hard, no matter what the cost of growth is. And we've seen that this year. So the yellow line on that chart shows you the CRB industrial commodity index. And this is a broad-based index of industrial goods, things like cotton, burlap, zinc, scrap metal prices. There's about 8 or 10 different things that go into this that are all industrial use materials. They're not things that are speculator driven, and they're not things that are end materials. So these are truly in the supply chain. And you can see where the cost of where that index has gone, shooting up. So we would expect over the next 3 to 6 months that credit impulse slowdown relieves that pressure on commodities, and we think there will be a slowdown in the inflationary impacts that are going on. And the big outlier and the big question mark, and we can talk about this as we go on, is what's going to happen to energy prices, and whether that's going to be the ultimate leader for inflation going forward, or whether we're going to get more supply coming on stream. My views are probably more similar to Filippo's in that there is a structural shift with ESG in terms of capex in the energy sector, and this is going to lead to a supply crunch before we get enough renewable capacity online. Where are we investing and what are we looking at? So the China slowdown story is in full flow. We think that the real opportunities in emerging markets right now are in the economies that are reopening post-COVID. So we would put that into Brazil and India, as well as some in Mexico. Those are the areas where we think that you've had this pent-up demand, you've had quite strict lockdowns, you've had the Delta variant, we're now coming out of those. And so the domestic consumption side is where we're focused, and whether that's e-commerce, bricks and mortar commerce, airlines, travel, etc. We think there's opportunity in those markets. But as we talk about our hedging, we are hedging all of that with some hedges on energy, because again, we think that's the biggest risk to markets out there for the next 3 to 6 months, is some sort of energy crisis leading to a derating of equities as people worry about higher interest rates and bigger problems in supply chains.
Thank you, Sanjeev. I think we gave a little bit of extensive overview on emerging markets, but I'll come back to you later with some other question. So today I'm going to involve also our CEO, Alessandra Manuli, just to an overview on alternative strategies. Of course, alternative strategies came back in focus, we might say, in 2020, since we had the COVID crisis. This year has been much more directional, so probably less attention to alternative strategies, even if the only solution for portfolio has been equity. And so at the end, there is still curiosity coming back to this kind of allocation. So, Alessandra, what do you think in terms of alternative allocation into portfolios going forward? I mean, at least looking 6 to 12 months ahead of us, in front of us.
I will try to give to this difficult question a very easy answer. What I can definitely say that we all expect the next 6 to 9 months to be more difficult than the last 8. And definitely we expect a less directional market with more uncertainty going forward. So I would say that the easy answer is that it's better to be long short than just long. So I think that what our managers have been explaining you in the last half an hour is that in the market we wait ahead is better to select single longs carefully. With a very fundamental and deep analysis, to select single short carefully and have a hedge approach to protect from volatility. So we definitely expect that we can add value with a more flexible and protect approach than a typical buy and hold strategy. The other answer is that it's very difficult for I was talking with many clients and asset allocators, is definitely to replace in portfolio the low volatility part. And so portfolio tend to have from 30, 50, 60, 70 in equity, considering how aggressive the clients are. And the easy answer is to use this low volatility part that is difficult to find good opportunities right now, increasing the alternative part.
Thank you. So now I'm going just to have a question for each of our managers, which I believe could be interesting for the audience. So I'll go back to Filippo. Filippo, of course, I mean, a lot of the allocation to credit is still into the high yield space. So do you still see value in the high yield space is the first question. And the second one, which I believe could be of interest, is do you think that the banks offers good value in terms of investment opportunity?
I would say that in terms of high yield, obviously there is, like we said at the beginning, we're very focused on selection. So, but if you ask me, do we see more long than short in high yield? Probably, it's probably more like the companies that seems okay, but unexciting because you only have a little bit of carry. But we see plenty of opportunity for shorts because there's a lot of those business there and credit are priced a little bit for perfection. Obviously, a yield is very also structurally exposed to the macro headwinds in the sense that most of the yield market is a naked interest rate. So effectively, you will long, the bond or the treasury implicitly, and this portion of the risk are very rarely hedged. So if there were like a decompression of yields or of the curve for whatever reason, is it because inflation or because QE or policy mistake, I think we will see a more than a non-linear expansion of spread as we had a non-linear compression with QE over the last 10 years. I think we could see a non-linear expansion. So I yield is probably the most dangerous place to be, a little bit like 81 for us, those places where the yield is very, very little. And so whether rates move or spread moves or something goes wrong with the credit, you can get really hammered. In terms of banks, we look at the entire capital structure. So when it comes to banks, I think there are a few interesting opportunity on this kind of LT2, tier one, distress opportunity. There is always some sort of restructuring in terms of banks, whether it's Metro in UK or Paschi in Italy. But at the same time, I think the opportunity that we see is predominantly in equity, to the extent that we think there is, growth stays still okay, but there's a bit of inflation, less QE, there's a little bit of movement there. Then I think, banks equity, probably there is a little bit of opportunity. And although we see a lot of pressure from fintech, we think a lot of the big banks can actually take advantage of fintech. And so that actually technology can become a bit of a booster. So, I yield very much dislike it, be very careful. Banks on the equity, I would I would consider having a small allocation as a kind of, bullish kind of case.
And another question from the audience. What do you think are the possible spillover effects from Evergrande on credit market outside China? And what are the liquidity conditions in the credit market in these last days?
As I said, Evergrande is to me is as most of China is totally unpredictable, as nobody was expecting this tightening on the technological stocks. Nobody can really give me a number of how much debt there is associated to Evergrande through the wealth management product. So, I would say that the consensus is that China will manage that relatively orderly. So in theory, you shouldn't really see much spillover. But I think, there is definitely, a 20-30% chance this thing gets, and, becomes quite, difficult to manage or too expensive to manage. And not to mention, there is a lot of offshore bonds that would involve UK and US courts in the process, creating all sort of other tensions. But, overall, my feeling is that the market is very relaxed about it. So, and maybe the consensus is right. I would still think China's got enough ammunition to manage this properly, but I don't know the size. So what I know is that China obviously has been predominantly a very consensual long in credit portfolio because of the yield, obviously a little bit like similar to kind of the 81 in Europe. So on that side, I am, I'm a little bit, careful in the sense that, because not for any other reason, but because I think, I don't think it's Lehman, but I don't think you need a Lehman situation to trigger a Lehman market now. What I'm saying is that the liquidity in the market is relatively poor. I think investment banks do not commit capital as a proprietary shop anymore. I think hedge fund is a lot smaller. So most of the assets are managed through, long only, ETF, daily usage, so I always look at a combination of A, the event, and B, the liquidity multiplier. I think the liquidity multiplier is a lot higher. I think as an event Evergrande, I would think should be manageable, but we remain very alert. We very, very cautious.
Thank you. I'll move to Paul, and then I'll come back with a question for all of you from our audience. Paul, in terms of the UK market, do you think, the equity market in the UK is today mostly affected by collateral effects still from the Brexit, or more on the macro? So how will you approach it, rather looking at the Brexit effects or to the general macro?
Yeah, it's an interesting one, the Brexit effects, because of course we've sort of been through Brexit and then we were plunged into COVID. And I think most people were thinking, actually, maybe Brexit wasn't quite so bad. Maybe it was a good idea. I'm politically neutral, obviously. But kind of what's happened now is, as economies have restarted, maybe some of the fears over Brexit are coming back. And the big one in the UK is around labour, particularly in a few sectors like food manufacturing, hospitality, so pubs and restaurants, and of distribution warehouses, lorries, that kind of thing. So what happened there is a lot of that Eastern European labour, so Poland, Romania, Lithuania, Baltic states, a lot of that came into the UK. A lot of it became very anglicised. But the people who went home, and some of those people, remember, went home on the UK furlough scheme. So they were being paid pretty juicy, and they'll get another 7 days of this, pretty juicy 80% salary paid into your bank account in Eastern Europe. You're living like a king and you're not working at all in the UK. That's quite a good result for you. So you come to the end of that period, and you think, actually, do I want to go back there? The risk of maybe being locked down again. I've done quite well. So that's been the unexpected thing, is furlough, the government's scheme for keeping people employed, has actually been a bit of a bind for them, because it means a lot of this labour isn't coming back, even if the government said, right, we're going to open the borders and everyone can come home. So that's been an unexpected pain, I think, for people. The silver lining to that cloud is that there's probably enough people in the UK who can do that work. And if wages go up as they're likely to do, and maybe wages for lorry drivers in the UK have been too low for too long because of that influx of labour, then maybe we get that consumer benefit of higher wages fundamentally. Okay, we get some inflation in the process, and better, more employed, more engaged. So it could solve a few issues in the UK. So that's the silver lining, but that's not coming for a couple of years. So short term, definitely some pain there. I think some of the wider raw material stuff that both Sanjeev and Filippo have talked about, and gas prices and things, they're not just UK things, and we can create a bit of a UK story around them. And the CO2 thing is probably a bit of a UK thing, because we don't have that many UK manufacturing plants for fertilizer, which produces CO2, and we like our beer. So we're not making enough fertilizer to grow the barley to make our beer. We want to carry on drinking beer, but we can't put CO2 in it. It's a bit of a conundrum. I think the CO2 thing will get sorted in this coming quarter. I think lorry drivers get sorted next quarter. So they're definitely a couple of challenges for us. So what's happened here, it's been quite interesting, is most companies were planning for a bit of this. So companies that were probably trading very well are now just trading well. So far we haven't had any, actually, we're not trading well at all. It's a profits warning. And I think that shows there's been a lot of fat in UK earnings. So disappointing that some of that's been taken out, but good that there seems to be some slack in the system to pick it up. So that gives us a little bit more caution around UK earnings in Q4, but also, keeping our eyes out for some more short ideas as well. So a pretty convoluted answer, but not just Brexit.
Thank you, Paul. I'm moving to Sanjeev. Sanjeev, just a question. Who are, if any, the winners of this Chinese slowdown?
Look, our view is that a Chinese slowdown that leads to a calming down of inflation is, in some ways, a good for the rest of the world, because it puts the Fed more on hold. It means monetary policy can run easier everywhere else if the inflation shock is transitory, and ultimately that helps the emerging economies where you've got good good consumer markets. So, our top picks are Brazil and India. And those are the places we think that have the best opportunities for investments. We think Brazil, with the e-commerce and payments revolution that's going on there, has a very strong profile. And similarly in India, with the changes that they've made over the last 5 years or so, with the GST, with demonetization, with cleaning up the system a lot, India's in a prime position to benefit from the reforms that have happened over the last 4 or 5 years in India. So, our view is companies like Reliance in India, or companies like Petrobras in Brazil, which gives you an oil hedge, as well as a consumption hedge, as well as a lot of the e-commerce and fintech players are where we want to be. So we've got a combination in our portfolio of e-commerce, fintech, and bricks and mortars, retail, plus some energy stocks to hedge against that energy risk.
Perfect, thank you. And then we have a question from the audience, which I believe is interesting to have just a line from all of you. The question is, the problems of Evergrande were well known since some time, but market always appear to react all of a sudden to the news. Do you think the same will happen once tapering will be finally announced? So Sanjeev, if you want to start.
Yeah, look, I think Evergrande's problems were known for many years. We have not invested in a single Chinese property developer. I think probably since about 2007 was the last time I had an investment in a Chinese property developer. They're over levered, they have a lot of problems, and there's a lot of corruption. The problem is that the market generally doesn't react until it's all on the front page of the newspaper. And that's generally how these things work. We talk, like Paul, we talk to a lot of businesses and a lot of companies. And what the companies tell us is generally, a long way ahead of what the newspaper says on the front page. And but the markets tend to react to that. So yes, I would agree that that's how that works. I think with tapering, it's a little bit more of a complicated question because it depends on what are you trying to achieve with tapering. If you look at the bounce back in the US, GDP in the US is above the pre-pandemic levels, even though the workforce is much, much smaller. So there is a lot of slack in the system still. And if this Chinese credit slowdown leads to commodity prices coming down, then I think the tapering is off the table because there's really those inflationary pressures disappear. The one thing that we've sort of mentioned and Paul's mentioned and Filippo's mentioned is energy. And that's one thing I am really worried about. And I think so when you think about what could cause tapering, what is the inflationary problem globally? If oil prices stay behaved, then I don't think we have an inflation problem, and I don't think there's going to be a big tapering. If oil prices have a problem, then everybody has a problem, and then potentially there's tapering. So I think that's going to be the big swing factor, and that's the one thing that our biggest. If you think about what is your biggest macro risk globally, for us, it's not the tapering, it's oil prices, and that's what we're most worried about.
Clear, thank you. Paul, would you add something on tapering risks for your way of managing the portfolio?
Yeah, I think one of the reasons you might select an absolute return strategy is to get around that issue of, the market seems to know these things are going on. When they come out, then there's a big crash situation. I don't think so far in equity markets, UK, Europe, Evergrande, it's been a big issue for equity markets per se. I think things like luxury have actually been more hit by China clampdowns. So my view would be, yes, of course, you're absolutely right. The market's slow on these things, but that's why hopefully if you select your absolute return strategies well, that's why we have protection, because we're trying to second guess that. And as Sanjeev says, we've got that perhaps access to management teams to give us a fuller view. So yeah, it's always, oh yeah, there we go again. But hopefully we've got the protection to make life a little bit easier for investors.
Yeah, Filippo, I leave it to you for the last comments on this question.
I mean, I completely agree with what Sanjay and Paul said. You know, the one thing I would add is obviously the structure of the market has changed in the sense, obviously, there's a lot more retail participation and there's a lot more institutional, which are like structurally long only. So I think, you know, sometimes the reaction, sometimes the market is becoming less of a pricing predictive machine and more like a reactive one. And I think that has been a little bit ongoing and is probably here to stay. The second, more generic, which is something that, you know, that really supports our approach and strategy, as I understand, of the same for Sanjay and Paul, is that obviously, you know, people that have been short or even venture into some short position didn't really enjoy it for the last 5-6 years, if not 10. And so obviously there is a big demand supply imbalance there. So to the extent that you find the next, you know, could be Evergrande, could be Wirecard, you know, could be even just something a lot less brutal than that, then I think you paid. And then you pay to have an absolute return strategy because actually you get that kind of, you know, ability, which then sort of fits with the next question about tapering. You know, the macro picture will be difficult going forward. I think that's why, you know, selection, credit, and equity is paramount importance. On the tapering, it all depends on the size and everything else. But you know, as we compress exponentially on the way down, you know, I think we may see something, you know, similar on the way back. So I think, you know, I'll be very cautious seeing what is the market reaction, because in the end of the day, what matters is the amount of buyers versus sellers. And, you know, if central banks stop buying, it would have a big impact. In our view, it could be one, you know, disruptive kind of reaction with a lag. You know, it may actually happen over time after the, you know, the few 10-20 billion a month get taken away from the market.
Thank you. Okay, I'm gonna conclude with Alessandra. Alessandra, of course, I mean, you said many things, many interesting things, hopefully. Of course, I mean, Hedge Invest has a huge focus on alternatives. In the last 3 years, the UCITS platform has changed. We had new strategies. So would you just comment on this, restructuring we are going through, and why, I mean, we decided to go for market neutral strategies for long short, even in the emerging market, and to keep on the long short on the credit space?
Yes, the goal of Hedge Invest is to find excellent managers with a unique approach and approaches. And so I think that this is definitely the case of the last 2 funds, and obviously also Filippo, but we are thinking about the last 2 editions of our platform. Sanjeev has definitely an excellent track record, background. The team is excellent, as you have the time to listen today and in the last few months. And also the strategy is unique because it's difficult to find an emerging market that has such low net and with so much attention to control volatility. You see a lot of emerging market manager rounds that are more directional, high volatility. So we think that what we are offering is really unique. The same can be said about Paul and his team. You know Paul for a long time. He's excellent track record. We think that the team he put in place is unique. And okay, market neutral strategy in the European market is more common, so we have more competition on this arena. But also in this case, I can say that the way we are implementing the strategy is pretty unique because we pay great attention on factor risk, sector risk. So we are neutral, not just on a sector base, but also on a factor base. You see a lot of market neutral around with a lot of volatility that have quality bias, a growth bias. In this case, we really try to add value, picking single stocks, and the addition of the increase of the UK market. It is definitely something that makes this strategy even more unique than before. On the other side, obviously, today we had we spoke about also our historic and successful fund that is Numen Credit. That also in this case, I want to highlight the fact that it is definitely a unique strategy that you can't find around, because being such opportunistic, long and short, and real short on the credit side, there is not many other funds that can be compared to the Filippo strategy. So we are happy, we're very happy with the quality of our platform. Thank you.
Thank you, Alessandra. Thank you to all of you for listening today, and thanks to our portfolio managers for the views on the market. Hopefully this was helpful for everyone. Thank you, and see you next time.
Thank you. Thanks, everybody.
Thank you.
Everyone, cheerio, goodbye.
Goodbye.
Bye.
Bye-bye.